I'm Sheila Lamb, and I'm with the Virginia SBDC Network. For those of you that are not familiar with our organization, the Virginia Small Business Development Center is a partnership program with the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 27 locations across the Commonwealth, we provide training and technical assistance to small businesses in their local communities. Our one-on-one advising services are available at no charge. Today's webinar, Introduction to Schedule C and Business Record Keeping, is presented by the Virginia SBDC Network and the Alexandria SBDC. We are recording today's presentation and it will be posted on our website, virginiasbdc.org. Due to the large number of participants, everyone's microphone is muted, but if you have questions during the presentation, you can type those into the Q&A box. We have also enabled the live transcript function, which you can show or hide via your own meeting controls. And now it is my pleasure to introduce our presenter for today's session, Anika Pompey, Senior Stakeholder Liaison with the Internal Revenue Service in Washington, D.C. As a stakeholder liaison, she is responsible for establishing and maintaining relationships with tax practitioners, business and industry organizations, and other audiences for the purpose of providing education and outreach on IRS policies, practices, and procedures. Prior to becoming a senior stakeholder liaison, Anika held the position of tax compliance officer. In this role, she planned and conducted examinations of individual income tax returns and was also responsible for educating taxpayers about tax law and tax-related accounting. Anika held the position of TCO for 7 years before becoming the frontline manager of a TCO group. She has also held the position of contact representative, where she was responsible for assisting customers with their tax accounts. Overall, Anika's IRS career spans more than 15 years. Please join me in welcoming our presenter today, Anika Pompey.
Good morning, everyone, and thank you so much for that wonderful introduction. Today's workshop is Introduction to Schedule C and Business Record Keeping. We have a lot of great information to share today, so we're going to go ahead and do a quick overview, and then we'll get started on that content. So in this lesson, I will provide an overview of the Form 1040 Schedule C, profit or loss from business. I'm also going to discuss how to calculate your profit, your gross profit and your gross income. We'll discuss how to document your income and expenses and how you should show you how to deduct those expenses. And then we're also going to discuss calculating your net profit or loss. And also in this discussion, we are going to talk about self-employment tax and estimated tax and other areas of interest on the Form 1040. I will provide you with some references for more information. We do have a lot to share, so let's go ahead and get started. Okay, so what is a Schedule C? Taxpayers, specifically business owners, sole proprietors or single member LLCs, they will use a Schedule C, Form 1040, to report income and loss from a business that they operate or profession that is practiced, again, as a sole proprietor or a single member LLC. An activity qualifies as a business if it is the primary, your primary purpose is for engaging in the activity for income or profit, or you're involved in the activity with continuity and regularity. So Schedule C has a total of 5 parts. We're going to discuss the various sections of the Schedule C throughout this presentation, beginning with part 1. So the image that you see here in this particular slide is part 1. You're going to complete the Schedule C. You'll first need to fill in your standard information about yourself and your business. So in this section, you'll include the name of the proprietor and their social security number. You'll also include the name of the business and the EIN, if you have one, as well as your business address. And you'll also notice that there is a place for you to enter a principal business or professional activity code. This is line B. These codes are based on the North American Industry Classification System, and the Schedule C instructions actually contain a list of these 6-digit codes. for your records. And we're going to talk about cost of goods sold. We're going to discuss gross profit and gross income. I'll chat with you a bit about bartering. And then we're going to touch on some expenses, particularly car and truck expense, depreciation, legal and professional services and office expense, supplies, and travel, meals, and entertainment. And I'll define these expenses and discuss how to document these expenses for your record. And then lastly, we'll talk about your net profit and loss. Okay, so let's go ahead and start with gross receipts and returns and allowances. So your gross receipts are the income that a business derives from the sale of its products or services. And when you're operating your business, you will receive money or property from many different sources. Now, your records can identify the sources of your receipts, and you're going to need this information to separate your business from your non-business receipts and your taxable from your non-taxable income. And we're going to discuss how to document gross receipts in the next slide. The second term I want to cover is returns and allowances. So returns and allowances include the cash or credit refunds you make to customers, rebates, and other allowances off the actual sales price. And individuals who don't make or buy products for resale as part of their business don't have a returns or allowance to deduct from their gross receipts. Now let's talk about documenting gross receipts. One of the first things you should do when you start a business is open a business checking account. It is important that gross receipts are deposited into a separate bank account, and you should keep your business account separate from your personal checking account. This is very important. You do not want to commingle funds, and you should deposit all daily receipts in your business checking account. So make sure to identify the source of these deposits as either business income, personal funds, or loans. And you should also note on the deposit slip the source of the deposits and keep copies of all slips as well. I just saw a message that my volume is low. Does this sound a little bit better? Okay. All right. Okay. So it is important that you reconcile your income regularly and make sure you keep documents that support all of your gross receipts. You want to document your gross receipts you using the following, such cash register tapes, bank deposit slips, receipt books, invoices, credit card charge slips, and then also the Form 1099 miscellaneous or Form 1099 NEC. All right, so the next thing I want to discuss is cost of goods sold. Cost of goods sold is the cost to a business to buy or make the product that is sold. It is easy to calculate the cost of goods sold if you sell all of your merchandise during the same year. However, your sales will probably be from inventory that your sales will probably be from inventory that you carried over from earlier years, and you'll probably have inventory left unsold at the end of the year. So some examples of businesses with cost of goods sold are like online retailers, clothing retailers, jewelers, restaurants, bars, and so forth and so on. Now, to calculate your cost of goods sold, you want to start with the cost of the inventory on hand at the beginning of the year, and then you're going to add the cost of any additional goods purchased or manufactured during the year. And then we're going to subtract the cost of any merchandise withdrawn for personal use. And the result is going to be the cost of items available for sale during the year. And then from that amount, we're going to subtract the value of your inventory at the end of the year, and your cost of goods sold is going to be the final total. Now, this calculation is in part 3 of the cost of goods sold in Schedule C. So this is an image of Schedule C, Part 3. You can refer to Schedule C instructions for more information on completing this section of your return, or your preparer will do it for you. You just want to make sure that you provide them with the information necessary to complete this computation. Now, if you are a business that buys or makes products for resale, you should not be deducting your cost of goods sold as supplies expense. It is cost of goods sold, and you'll need to complete the computation for the deduction as outlined in Part 3 of the Schedule C. And we're going to discuss supplies a little later in the presentation, so you'll have a better understanding of what expenses are considered supplies. All right, so next I want to uh, discuss gross profit and gross income. So to calculate your gross profit, you're first going to subtract your returns and allowances from your total gross receipts. And then you're going to subtract the cost of goods sold from that difference. And then from there, you're going to add other income. And this can include bartering income, which I'm going to talk about in the next slide. And then the final term I want to cover in this section is gross income. So your gross income is simply going to be the sum of your gross profit and other income. And you can refer to the instruction for Schedule C for more information on what counts as other income. Now, if you take a look at I'm sorry, let's talk about bartering income. So bartering occurs when you exchange goods or services without exchanging money. So an example of bartering is, let's say you're a plumber and you're doing repair work for a dentist in exchange for dental services. The fair market value of the goods and services must be included in the income of both parties. So income from bartering, it is actually taxable in the year in which you receive the goods or services. Now you can find a lot more information regarding bartering in IRS publication 525. That is taxable and non-taxable income. All right, so if you take a look at the slide in this image, this is part 2 of the Schedule C, income. And so what this is where you're going to compute your gross income. As I mentioned previously, you're going to first need to determine your gross receipts, and you'll do so by referencing your records for gross receipts. And you're then going to subtract the returns and allowances and the cost of goods sold. You'll add other income, and this is going to give you your total gross income. All right, so we're going to move on and talk about completing Schedule C Part 3, which is for expenses. Um, Business owners are allowed to take a deduction for their day-to-day, ordinary, and necessary business expenses. Um, you can refer to publication 535, which is business expenses, for more information on business expenses. But before we talk about expenses in particular, I do want to mention that record keeping is going to be very pivotal when it comes to completing Part 3 of the Schedule C. Your records are going to need, they're going to help you prepare your tax return. So maintaining good records um, are going to help you keep track of your deductible expenses. You know, over time, you may forget expenses when you prepare your tax return if you're not regularly recording your expenses. And no one wants to miss out on any deductible expenses. So you should definitely make a habit of regularly recording and reconciling your expenses. And it is also important to note that you must keep your business records available for inspection by the IRS. If the IRS examines any of your tax returns, you may be asked to explain the items reported on your income tax return. Um, so a complete set of records is going to help you speed up your examination. Now, you may choose any record keeping system that is suited to your business, that is going to clearly show your income and expenses. And your record keeping system should also include a summary of your business transactions. So this summary is ordinarily going to be made up of your business books, such as your accounting journals and ledgers, and you must show your gross income as well as your deductions and credits. Again, you can refer to publication 535, Business Expenses, for more details regarding business expenses. All right, so this particular slide is an image of Schedule C Part 3. So as you see, there is a total of 20 different expense types that can be deducted on Schedule C. And of course, these expenses are discussed in more detail in publication 535. Now, let's talk about documenting your business expenses. So your purchases, sales, and other transactions that you have in business are going to generate supporting documents for your expenses. Your supporting documents can include, but are not limited to, sales slips, paid bills, account statements, invoices, receipts, and canceled checks. And these documents I just described are generally going to provide documentary evidence that you need to support your business expenses, and they contain the information you need to record in your books. So it is important that these documents, that you keep these documents, because they support the entries on your tax return, and make sure you keep them in an orderly fashion and in a safe place. For more detailed information, you can refer to publication 583, Starting a Business and Keeping Records. Now, the system that you use to record business transactions is going to be way more effective if you follow good record keeping practices. For example, you want to record expenses when they occur, and then you also want to make sure you identify the source of the recorded receipt. Generally, it is best to record transactions on a daily basis, but we do understand as business owners, you might not be able to keep up with records on a daily basis. As long as you record them at least on a weekly basis, it is going to be considered a timely kept record. Now, there are some expenses you will incur in business that are going to require additional documentary evidence, and I'm going to discuss those in more detail with you. The first expense I want to discuss is the car and truck expense. Now, if you use your car for business only, you may base your deduction on the full cost of operating the vehicle. But if you use your car for both business and personal purposes, you have to divide your expense between business and personal use based on mileage to compute a business percentage. You don't want to include commuting to and from your place of business as business mileage. And I'm going to define commuting for you a little later. You may take a deduction for actual business expenses for the car, or you can use the standard mileage rate. So let me define actual expense and standard mileage rate for you. Actual business expenses include gas, oil, repairs, insurance, depreciation, tires, um, license plates, and any other expense you incur to keep the vehicle operable. The standard mileage rate means that you're going to be multiplying your business mileage by the standard rate. The standard rate can be found on the IRS website, and the standard rate for 2023 is 65.5 cents per mile. Now, if you use 4 vehicles or less for business, you may use a standard mileage rate. However, to use a standard mileage rate on a vehicle after the first year of business, you must have used the standard mileage rate the first year. And in later years, you can choose between standard mileage and actual expense. And if you claim actual expense in the first year of business use, you must continue to use actual expense. Now, parking fees, tolls, and tolls are deductible, whether you choose to use the standard mileage rate or the actual expense. And to document your car expense, you will need, in addition to any receipts and invoices, you'll need the cost of the car and any improvements, the date you started using it for business, the date of each business use, the mileage for each business use, the total miles for the year, the business destination, and the business purpose of the trip. All right, so I want to turn your attention to the table in this slide. This slide details what transportation expenses are deductible and which are not. So this table can be found in publication 463. And before you begin documenting mileage, you'll need to determine whether the miles you drove are deductible business miles or commuting miles. So let's first define home. So home is the place where you reside, and your transportation expense between your home and your main place or regular place of work are not deductible. These are considered personal commuting expenses. Your regular or main job is your principal place of business. So if you have more than one job, you must determine which one is your regular or main job. So consider the time you spend at each, the activity you have at each, and the income you earn at each. And driving from your main job to a temporary work location or to a second job is deductible. All right. And then you have the temporary work location. Your temporary work location is a place where your work assignment is realistically expected to last and does in fact last 1 year or less. So you can take a deduction from your home to a temporary work location if you have a regular or main job location. Now, let me give you an example that can hopefully provide additional clarification. Example one, uh, let's say I'm a computer repair technician. I have a storefront at a local shopping center. I drive from my storefront every day to service customers. Um, my mileage from my home to my storefront is not deductible because my storefront is my regular place of business. And driving to my storefront is commuting. But the mileage that I incur uh, driving to my customers is actually deductible. So just using that same scenario, if I do service calls to a business client, and several times a week, I go to my client's place of business to perform repairs, and I leave from my storefront location, or even if I leave from my home, in that particular situation, my business miles are deductible because I'm traveling from my home or my storefront to a temporary work location. I hope these examples have provided some clarification, but again, you can refer to publication 463 for more detail. All right. If you do claim any car and truck expenses, you must provide certain information on the use of your vehicle on Schedule C, Part 4, information on your vehicle, and then you'll complete this part only if you're claiming car and truck expense on line 9 of Schedule C, and you're not required to file Form 4562 depreciation and amortization, including information on listed property. So you can see instructions for Schedule C for more information. All right. The second expense I want to discuss with you all is depreciation. So, depreciation is the annual deduction allowed to recover the cost of other bases of business or investment property having a useful life substantially beyond the tax year. We typically refer to these types of properties as assets, and some examples of assets include machinery, furniture, equipment, and vehicles. Depreciation starts when you first use the property in your business or to produce income, and it ends when you either take the property out of service, deduct all of your depreciable costs or other bases, or you no longer use the property in your business or to produce income. You do not depreciate land, inventory, or property that you placed in service and disposed of in the same year. Now, there are two main methods of depreciation. They are the modified accelerated cost recovery system and the Section 179 deduction. So the method for depreciating most tangible property, which is property that you can see or touch, is the modified accelerated cost recovery system. It is commonly referred to by its initials, makers, MACRS, and we pronounce it makers. So the general rule of Section 179 allows taxpayers to elect to expense the cost of Section 179 property that they purchased and placed in service during the taxable year. And taxpayers can elect on Form 4562 to expense the cost of Section 179 property. Now, the deduction amount of the elected Section 179 expense that can be deducted in any taxable year is going to be limited to the amount of taxable income for tax years in which there is an active trade of business. IRS publication 946, How to Depreciate Property, is going to explain all about makers and the Section 179 deduction and what property does and does not qualify for Section 179 deduction, what limits apply, and how to elect it. Now, uh, you have to keep records to verify certain information about your business assets, and you need your records to compute your annual depreciation and the gain or loss when you sell that asset. So, Documents for assets should show the following information. It should show when and how you acquired the asset. It should show the purchase price. It should show the cost of any improvements. Section 179 deduction taken, whether uh, deductions were taken for depreciation, if there are any deductions taken for casualty losses, such as losses resulting from fires or storms. It should show how you use the asset and when and how you dispose of the asset, the selling price, and any expenses of sale. Now, documents such as your purchase and sales invoices, real estate closing statements, and then cancel checks or other documents that identify the payee, amount, and proof of payment should show the information that I just mentioned. And you always want to make sure you keep records of any depreciation schedule. All right, so I'm going to move on to discuss supplies expense. So in most cases, you can deduct the cost of materials and supplies only to the extent that you consumed and used them in your business during the tax year. If you're a business that buys or make items for resale, make sure you're deducting your inventory. Make sure you're not deducting your inventory as supplies. Again, they're considered cost of goods sold. And as I showed you earlier, you should compute your cost of goods sold in part 3 of your Schedule C. But just to give you some examples, supplies will be considered like the cost of books, any professional instruments that you use, uh, if you normally use it within a year. If the useful life, however, extends substantially beyond the year, then you generally have to recover that cost through depreciation, which we just discussed. All right, so moving on, we're going to touch on travel, meals, and entertainment. So as a business owner, you may incur meals in one of two ways, either by entertaining clients or by way of overnight business travel. So the Tax Cuts and Jobs Act of 2017, uh, the tax law from that eliminated the deduction for any expenses related to activities that were generally considered like entertainment, amusement, or recreation. But businesses may continue to deduct 50% of the cost of business meals if the business owner or an employee of the business is present and the food or beverage is not considered lavish or, or extravagant. So the meals may be provided to a current or potential business customer, client, consultant, or some other similar business contact. Food and beverages that are provided during entertainment events will not be considered entertainment if purchased separately from the event. A restaurant receipt, for example, is going to be enough to prove an expense for business meals if it has all of the following information: the name and location of the restaurant, the number of people served, the date and amount of the expense. So remember, it has to include all of those three things to be considered an adequate record. And if there are charges made for items other than food and beverages, the receipt has to show that as well. Now, for the travel part of travel and meals, you're going to enter expenses for lodging and transportation connected with overnight travel for business while away from your tax home. And the term tax home refers to your main place of business, regardless of where you maintain your family home. So for the meals expense, you're going to enter a deductible business meals expense. And this includes expenses for meals while traveling away from home for business and also meals that are business related. So meals uh, with clients. Now, you have to keep records to prove the time, place, and the business purpose of your travel. But instead of using your deduction on the actual cost of your meals while on business travel, you can actually use a standard meal allowance for your daily meals and incidentals. So much like we have a standard mileage rate, we have a standard meals and incidental rate. Now, under this method, you can deduct a specified amount depending on where you travel instead of keeping record of your actual meal expenses. The standard meal allowance is the federal meals and incidental expense. That is, you can find information on these for these rates on the U.S. General Services Administration website at www.gsa.gov, and you can click on per diem rates link. And from there, you can either search by city and state, or you can search by the zip code. In most cases, whether you use the actual expense or the standard meal allowance, you can still only deduct 50% of the business meals and entertainment, including any meals that you occur while away from home or business. Now, for more information on travel, meals, and entertainment expense, you can refer to IRS Publication 463, Travel, Entertainment, Gift, and Card Expenses. And as I mentioned earlier, IRS Publication 535, Business Expenses, is going to tell you all about, you know, the various business expense deductions. Now, I want to turn your attention to the table in this slide. So this table is on page 26 of the current revision of Publication 463, and it provides details about the elements that are required to substantiate expenses for travel, gift, and transportation. So you should keep proof of that the proof you need to support these expenses in either an account book, a diary, a statement of expenses, or a similar record. And you'll also need to keep documentary evidence that, together with your records, are going to support each element of an expense. So documentary evidence can include receipts, canceled checks, bills and bills to support these expenses. And your documentary evidence will be considered adequate if it shows the amount, date, place, and the essential character of the expense. So, for example, a hotel receipt is going to be enough to support an expense for business travel if it has the name and the location of the hotel, the dates that you stayed there, and any separate amounts for lodging, meals, and telephone calls. You have to make sure that that hotel receipt is itemized. Now, record, you should record the elements of these expenses at or near the time the expense is incurred, um, and support it with sufficient documentary evidence. So I mentioned a timely kept records earlier, but again, a timely kept record is going to be way more valuable than a statement that is prepared later when you generally have a lack of general recall or accurate recall. So again, you don't need to write down these elements of every expense every day, because we do understand that you are operating businesses. But if you at least maintain a log on a weekly basis that it accounts for these expenses during the week, then that log is going to be considered a timely kept record. Um, so the last expense I want to cover with you all is the legal and professional and office expenses. So included in these expenses are going to be fees that are charged by uh, other professionals that you hire, such as your accountants and attorneys, that are ordinary and necessary expenses directly related to operating your business. It can also include fees for, tax-related advice for your business or the preparation of All right, so after you've determined your gross income and your total expense, you can proceed with computing your net profit or loss. And your net profit or loss is the amount by which the gross profit and any other income for a period is more or less in a loss than the business expense and the depreciation for the same period. So to calculate net profit or loss on Schedule C, you're going to start with your gross profit. You're going to add other income, and this is going to equal to out to be your gross income. And then you're going to subtract the total expense from expenses that you incurred for the business. And this is going to give you a tentative profit or loss. And from that, you'll then subtract any expense for business use of home. Um, and then this is going to give you either your net profit or your net loss from business. And you're going to report this profit or loss on Schedule 1, on your 1040, your 1040 SR, and also on your Schedule SE. Now you can refer to the Schedule C instructions for more information on computing net profit or loss. Okay, so some other possible deductions for the 1040 are going to be the health insurance and retirement plans. So let's first talk about health insurance. If you are not covered by an employer's subsidized health insurance plan, you may be able to deduct 100% of your health insurance premiums on Form 1040. And this is going to apply to an individual or a family health plan. You can learn more information about the health insurance deductions on uh, in IRS publication 535, business expenses. And second, if you're self-employed or a partner, you may be able to take a deduction on Form 1040 for self-employed SEP, simple, or qualified plans. And for more information on those, you can you can refer to publication 560, retirement plans for small businesses, and for more information. Uh, Now, I want to just briefly touch on deducting startup costs. Some of you in our audience today uh, may have started a business uh, within the last year or so, and you may have some startup costs. Business startup costs are the amounts that you paid or incurred for creating an active trade or business, or for investigating the creation or acquisition of an active trade or business. So qualifying startup costs are going to be, they are recoverable if you meet both of the following requirements. So one, it has to be a cost that could be deducted if you paid or incurred it to operate an existing trade or business in the same field. And also, it's a cost a business pays or incurs before the day their active trade or business begins. So as long as you meet those two qualifications, then um, you could uh, take a deduction for startup costs. And again, we do go into more detail about startup costs in publication 535. Okay, so now I want to turn you all's attention to record keeping time frames. So throughout our review of the Schedule C, we did discuss record keeping for gross receipts and expenses. Um, and now I just want to provide you with some information on record keeping timeframes. So the length of time that you should keep records is going to depend on the action, expense, or the event which the document records. So generally, you have to keep your records that support an item of income, deduction, or credit shown on your tax return until the period of limitations for that return runs out. Now, the period of limitations is the period of time in which you can amend your tax return to claim a credit or refund, or the IRS can assess additional tax. So I do want to remind you all that you should be keeping copies of your filed tax returns. Uh, they're going to help you prepare future tax returns, and they're also going to help you make computations if you need to file an amended return. So let's go over periods of limitation. Uh, you want to keep your records for at least 3 years from the date you filed your original return, and the returns filed before the due date are going to be treated as filed on the due date. So just give you an example. The filing due date for this year for your 2022 taxes is April 18th, 2023. So any return that is filed prior to April 18th, 2023 is going to be treated as if it were filed on April 18th, 2023. Now, you are going to want to keep your records indefinitely if you do not file a tax return. I hope there's no one out there who is not filing tax returns, but in the case that you are not filing tax returns, do not get rid of your records. Now, in regard to property or assets that you're using in business, you have to keep records relating to those until the period of limitation expires for the year in which you dispose of the property. So you're going to have to keep these records because they're going to help you figure your depreciation, amortization, or depletion deduction. And they're going to help you figure any gain or loss when you uh, sell or otherwise dispose of this property. Now, when the period of limitations for these records expires for the IRS, like you no longer need them for tax purposes, don't throw them away right away because you might have to keep them longer for other purposes. You might have to keep them longer. For example, let's say your insurance company or your creditors, they might need you to keep your records a little longer than the IRS requires you to keep them. So definitely before getting rid of any records, make sure you follow up with them to make sure you don't have to keep them any longer. All right, so let's move on. I want to turn your attention to self-employment tax and estimated tax. So self-employed people who are sole proprietors or partners in a partnership, they may be subject to self-employment tax. Self-employment tax is going to consist of your Social Security tax and Medicare taxes. And when you're an employee, generally your employee pays half and you pay half. But when you're self-employed, you are responsible for paying it all. So if you have a net profit from self-employment that is more than $400, you must file Form 1040 Schedule SE, self-employment tax. And we strongly urge all employees, including those with other sources of income, such as self-employment, to make sure they check their withholding. So if you are self-employed but also have an employer, just make sure you check your withholding with your employer. This is going to help you avoid any unexpected year-end tax bills and possibly any penalties in the future. The easiest way to do a checkup on your withholding is to use the tax withholding estimator on irs.gov. Now, when you are self-employed, you may have to pay what we call estimated tax. You know that when you work for someone else, they withhold federal taxes from your pay throughout the year. Well, when you're self-employed, you take care of this by paying estimated taxes throughout the year. Estimated taxes are used to make payments against any self-employment income and income tax liabilities that you will have at the end of the year that are associated with your business. A companion publication, publication 505, Tax Withholding and Estimated Tax, does have more details available, including worksheets and examples that will help you figure out whether you should be paying estimated taxes. And among the taxpayers who should consult publication 505 are those who also have dividend income or capital gains income or other special situations. Now, Form 1040 ES, estimated tax for individuals, uh, can also help taxpayers figure these payments simply and accurately. So to determine if you must pay estimated tax, you want to use Form 1040 ES to estimate your taxable income for the year and make sure you include your self-employment income and all other taxable income. It's very important that you include all other taxable income. Now, you generally have to make your estimated tax payments if you expect to owe taxes, including self-employment tax of $1,000 or more when you file your tax return. You simply use Form 1040 ES to calculate and pay the tax. And if you or your spouse also receives salaries and wages, you may be able to avoid having to make estimated tax payments on your income by asking your employer to take out more taxes on your earnings. To do so, you would just need to file a Form W-4, a new Form W-4, which is the Employer Withholding Allowance Certificate with your employer. But making estimated tax payments is easy. Now that most of the paperwork can be eliminated, uh, you can actually make electronic payments for your estimated tax payments using the Electronic Federal Tax Payment System. Um, for short, we call it EFTPS. Using this system allows you to make payments online or over the phone. And you can also use IRS Direct Pay. And then if you have an online account with the IRS, you can also use that to make estimated tax payments. And you can learn more about EFTPS by visiting their website at www.eftps.gov. But again, EFTPS does require registration, and it could take a few business days before you can gain access. But if you already have an IRS online account, and you simply just log into your online account to make an estimated payment, and then IRS Direct Pay, you don't even necessarily need to log into Direct Pay to make a payment, and that tool is available on the IRS website. Okay, so moving on. Each year, the combined amount of wages, tips, and net earnings subject to your Social Security withholding is going to change. Um, you do not have to withhold any more Social Security taxes once the combination reaches that limit. And this is going to be known as the wage-based limit. And the limit is published annually in IRS Publication 15. So if you receive wages in addition to your self-employment income, then you're going to subtract those wages from the maximum to calculate how much self-employment income is subject to tax. And if you have income subject to self-employment tax, you want to make sure you calculate that self-employment tax on your Schedule SE. This is another form associated with Form 1040. That is Schedule SE, SE short for self-employment tax. And if you have more than one business, make sure you use one Schedule SE and combine the profit and losses from all of your business. This is going to apply to both sole proprietors and partners. Now, all of your wages combined, along with tips, and any net earnings in the current year are going to be subject to any combination of the 2.9% Medicare part of the self-employment, Social Security tax, or the railroad retirement tax. Okay, so that concludes the presentation portion. I just want to do a quick review. So in this lesson, we did cover the basics of the Schedule C, including what business owners need to know about how to determine their gross profit and income, and how to identify deductible expenses and to calculate that net profit and loss. We also talked about the type of records you should keep for your gross income and your expenses, and then the additional records that are going to be required to record for specific expenses, such as like your car and truck, your travel and meals, your depreciation. We also went over certain areas of the Form 1040, as well as covered your self-employment tax and your estimated taxes. So you can find more information on all of the topics that we covered in this lesson in the IRS publications that are referenced throughout this presentation, including IRS publication 334, Tax Guide for Small Businesses, and the Small Business Tax Center on our IRS website. You can get to the Small Business Tax Center by visiting www.irs.com/smallbiz, that's BIZ. And this in the next slide, I just included hyperlinks to all of the publications that were referenced throughout this presentation. So once you get a copy of the slide deck, you simply just click on the hyperlink and it'll take you to the IRS webpage for these particular publications. Publication 525, taxable and non-taxable income. Publication 583, starting a business and keeping records. Pub 463, travel, entertainment, gift, and car expense. Publication 535, business expense. Publication 946, how to depreciate property. And then, of course, publication 505, tax reporting and estimated tax. And then that very last hyperlink is going to take you to the record keeping page on irs.gov. So you can find more information about record keeping there. So that covers my portion of the presentation. I see we do have a lot of Q&A. And so I'll turn it back over and we can start with the Q&A.
Yeah, we do. We have about 27 questions in our box here, so we will get started. I scroll back up to the top here. Let's see. Okay, Anika, let's see. The first question came right after you started. I am an S Corp. What's the difference between a K1 and a Schedule C?
Okay, so for an S Corp, a Schedule C business is going to report their profit, their gross income and their expenses on a Schedule C. And then, of course, the gross profit or loss from your Schedule C is going to flow through to your 1040, whereas on a K1, you said you're a partner or an S corporation. So you say you're an S corporation.
It says
With the
S
S
corp. Yeah.
corporation, you file an 1120S, and all of the income and expenses from the 1120 from the business are reported on an 1120, and then you report, and then each portion of the that net profit or loss is divided between the shareholders, and your portion of the profit or loss is reported on a Schedule K1. So then your K1 entry income, profit or loss is then going to flow through to your 1040.
Okay. So the next question here, is there a volume of sales that requires the cost of goods sold this way? Again, this was early on.
So there's not necessarily a volume of sales that requires you to do the cost of goods sold calculations. It's just that if you have an inventory of goods for sale, and you have a starting inventory and an inventory, regardless of how small or large that inventory is, you should calculate your cost of goods sold using the method in Schedule C, Part 3. It's not really like a minimum value.
Next question was, does this apply to services too? Again, when you were talking about cost of goods sold.
No, so service businesses who are service oriented, you don't necessarily, if they don't have a product for sale per se, services are more so, I guess, along the lines of an expertise that they offer. Let's say, for example, a tax return preparer. They offer a service of preparing your income tax return. So they wouldn't have a cost of goods sold.
Does cost of inventory include things like mileage to pick up the goods or shipping charges?
The cost to pick up the goods would be, you would calculate, if you use a vehicle in business to, let's say, pick up the goods, you would take a deduction using car and truck expense. If I'm not mistaken, the cost for shipping of the goods would be considered a part of the cost of goods sold, but I can circle back and confirm that for you.
Can you explain the types of cost of goods sold classifications?
Can you elaborate on that?
Okay, we'll see if that person comes back. Let me just.
Because cost of goods sold could include the supplies that you need to make the goods. It could include the cost of labor that is used to make those goods. So it's a lot of different components that can make up cost of goods sold.
Okay, I'll check back in. We'll move on and I'll check back in and see if they clarify that. How many years do we need to keep a copy of the record keeping?
So if you file your tax return timely, you should keep your records for 3 years from the date that you file your tax return. If you're not filing your tax return timely, then you want to keep your records indefinitely. And then for items such as your assets or property that you use in business, you want to keep those records until you either dispose of the property or asset, or you sell it.
Did you review the cash versus actual portion of the Schedule C? This attendee says she might have missed it.
No, I didn't actually cover the cash versus actual portion. That wasn't included in this presentation, but I can definitely send some references regarding the cash versus accrual.
Okay, great. Yeah, we can include that in the follow-up email. Let's see. Okay, so how long should we keep a paper copy of the receipts and documentation? Is that, I guess that would be part of the record keeping if we scan and upload them digitally to QuickBooks?
Well, it would, so Okay, so you have to keep the records for at least 3 years from the time that you filed. If you have a paper receipt and you scan it and you upload it to QuickBooks, I'm guessing you don't necessarily need to keep the paper version because you have an electronic version. I don't know, maybe I'm just a hoarder. Like I would just keep that stuff in a file until I would just keep all of it in a file until the 3-year period has passed. So that way you have an actual physical record, and then you have an electronic record, because, God forbid your electronic record gets corrupted or for some reason or other, then you just don't have it at all. So that, I guess that would really be up to you. Talk to if you have a return preparer or someone who does your bookkeeping, talk to them about the best method, but you do generally have to keep records for 3 years from the time that you file.
I think this one is a follow-up to the question about services. Materials are still used for services like advertising, marketing, and products for use in business use and equipment. Because they were just elaborating on.
Okay, repeat that for me one more time.
So she says materials are still used for services like advertising, marketing, and products for use in business use and equipment.
So on the Schedule C, there is actually a line item for advertising. So if you're a service business and then you are just advertising your business or marketing your business, then whatever it costs you incur to do that, you would just report it on the line item for advertising. I feel like it's line 9, but let me just confirm. And like I mentioned in the presentation, the Schedule C, it has at least 20 line items for various expenses. Of course, we didn't go over everyone for the purpose of time, but in general, as long as the expense is considered ordinary and necessary for business, and you of course incur the cost, then you can deduct the expense. I only went over particular expenses that require a bit more record keeping per se than just like a simple receipt or invoice. But yeah, advertising is reported on line 8 of your Schedule C.
Great. Okay, so is there a formal missing receipt form that we should fill out for expenses, or can we create our own and keep that?
When you say missing receipt, so I'm assuming that you have some other method to verify that you actually paid for an expense. You just don't have the actual physical receipt.
That's what it sounds like. I'm not sure. Let's see if they still on. And
okay, so no, we don't have an actual missing receipt form that you would fill out. When you're recording expense, I'm assuming like maybe you're going through your bank transactions and you see you made a purchase somewhere and you just don't have the physical receipt for it anymore. What I would suggest that you do is when you record, and I'm just using this as an example, if you use QuickBooks and you go to record that expense, just make sure you you include a detailed description of what that expense was and what their purpose was for the expense for business, if that makes sense.
sorry about that. What if your expenses are not itemized, but various expense items fall under different expense categories? Is a spreadsheet that breaks down the transaction acceptable evidence? And I think there was a clarification. The overall transaction has a receipt. However, the itemized items do not have a formal receipt.
Okay, I think I'm a little bit confused on that.
Okay, do you want me to read it one more time? See if it.
Yeah, read it for me one more time. So
What if
the actual transaction has a receipt, but
it
the
sounds like the
itemized,
overall has, but the components of it do not have individual receipts, which I would think the main one would cover it. I don't know. But they're asking if a spreadsheet that breaks down the transactions is acceptable.
So, well, if you're talking about acceptable for like audit purposes, no, you can't just go to an audit with a spreadsheet with numbers on it. We actually have to see the documents, the records that you use to come up with those numbers. So let's say, for example, if you have a spreadsheet and your spreadsheet says you had $4,000 in advertising, then you have to show us records that prove that you actually paid $4,000 for advertising, if that makes sense.
Okay, I'll come back and see if they elaborated there. Let's see.
But if you're talking about just like taking a spreadsheet to your return preparer and say, hey, this is everything that I paid for my business, prepare my tax return, you would have to, I guess, figure out with your preparer whether they accept that for return preparation or not.
Okay.
But I know for audit purposes, that wouldn't work.
Okay. Does the vehicle have to be listed with DMV as a business use, I guess, to write it off?
No.
That was a nice, simple answer.
Yeah.
Let's see. Okay, what if you work from home? I think this was all related to the vehicle expenses.
So if you work from home, then your primary business location is going to be your home. And then if you go to temporary work locations from your home, then those would be considered, deductible business miles.
Okay. So this one says, if you have a home office, can you write it off for mileage? I guess that's kind of tying into what you just said.
Well, it would depend on, so if your home office is your primary work location, and then you have to travel to a temporary work location, then the mileage from your primary work location to your temporary work location is deductible.
Okay, so how does transportation expense deductible apply if you have a home office? I think you just answered this, and at least office space when your home is your primary place of business. Does the mileage between count as business to business? And I think you said yes, right?
So, so you have a home office and then you have a second work location. I would refer back to publication 463, because you're going to have to figure out which place is your principal place of business. They both can't be a principal place of business.
So they do say the home is the primary place of business, and they're wanting to know if the mileage between counts as business to business. Does that make sense?
No, it does make sense.
Okay.
And so the lease space, like how often are they going to the lease space? I mean, because I don't want to, like, I don't know like all of the details of the business operation, so I don't want to tell you an answer and then it not be correct. You probably want to discuss those details and that information in detail with your return preparer, and then they can help you decide what your, if it is in fact a primary work location and whether you can deduct mileage to the second location.
Okay. I'm going to see if they follow up, but we'll go on to the next question before. Let's see.
Yeah, because I don't want to give tax advice. Like this workshop is like for informational purposes.
Right.
So I don't want to necessarily give tax advice and then, you come back a couple years later and says, no, see your stakeholder liaison, Anika Pompey said I could.
Okay, so I agree. So to confirm, if your consulting business is run from a home office, then commuting miles equals 0.
I'm sorry, repeat that one more time.
To confirm, if your consulting business is run from a home office, then commuting miles equals 0.
So you have a consulting business, you work from home. So your work is your main job. And then I'm assuming you go out into the field to meet with clients.
Yeah, it doesn't say.
Okay, so assuming that their home office is their main work location, and then they go out to the field to meet with clients, then the miles they incur to meet with clients is going to be deductible.
I'm just looking to see if anyone's followed up. Okay. Moving on, we still have a lot of questions. Let's
Okay.
see.
That's okay. We got a
Okay.
lot of time.
Yeah. Let's see. Okay. What if the entertainment is virtual, like a Zoom party in which food is paid for? I guess they're wondering if they can write that off.
Again, you should probably speak with a tax professional. Yeah, I would speak with a tax professional on that. Typically, again, for the entertainment expense, you have to be present. And yeah, I don't know if there are any caveats for virtual parties.
Okay. Can you take the standard meals and incidental rate and account for a business dinner on the same day? Or do you have to choose one method for the entire business trip, all receipts or all standard?
Yeah, you have to use one method for the entire business trip. You can't decide that I'm going to take the standard meals and incidental rate, but I also want to take 50% of this meal that I just purchased. The meals and incidental rate, depending on the city, because it varies from city to city. Of course, cities with higher cost of living rates are going to have a higher meals and incidental rate. But I mean, if you are entertaining a client and you come out with a bill that is, a few $100s, you should just probably take the actual expense, because those meals and incidental rates they're not, from what I understand, and from what I can recall, they're not greater than like $70 or $80, depending on the city that you're in. And then again, you only get 50% of that. So
Okay, do you have to keep the physical meal receipt, or can you scan the receipt, get rid of the original, and just keep the digital copy?
again, that's really going to be up to you, how you like to maintain your records. I personally would keep the digital and the physical, but I can't, the IRS does not have any set rule that says you have to have a physical copy.
Okay, so I think this question is, why might QB1 not be applicable if you operate at a loss?
The QBI is based off of the QBI is the calculation is based off of your net profit, your net profit. So if you don't have a net profit, then there's no way to calculate a percentage to allow a deduction. And just I just want to make sure he's talking about the QBID deduction, qualified business income deduction.
It says QBI, so I would think so, right? I would.
Okay.
So again, I'll look and see in a moment if there's a follow-up on that.
Okay.
So if business startup costs occur in a prior tax year before you actually start the business, can they be counted in the current year's tax return? So the example is incurred startup costs in late 2021, but didn't begin operating business until 2022.
Yes, any expense that's incurred prior to the actual start date of the business is going to be considered startup costs, even if it's not incurred in the same year.
How do I get old copies of old tax returns or W-2s?
You can request transcripts. We have tax return transcripts. There are a couple ways that you can do that. If you have an IRS online account, you can log into your online account and request tax return transcript and the wage and income transcripts. If you do not have an online account, or you have an issue with signing up for the online account, you can request transcripts using form 4506-T, and you just have to indicate on the form the type of transcripts that you would like. It takes a little longer to get them when you request it using the form, because they mail them to you, but that's the other option for obtaining transcripts.
On travel, if I use my personal vehicle but don't consider that vehicle a business expense, do I use mileage for the trip, or do I use actual gas receipts? And then if it's mileage, do I need to keep and record the fuel receipts?
So you can only do one or the other. If you are going to do mileage, then you would deduct mileage. And if you're going to do actual expenses, then you would use your actual gas receipts. But it sounds like maybe she uses another vehicle primarily for business. So she should probably talk to her tax professional. But again, you can only do one or the other. So
I think that was the main question.
okay.
Does the IRS have a standard recommendation for how much revenue/income to reserve for paying estimated taxes? The tax estimator you referenced doesn't let you continue if you don't have federal tax withheld by an employer.
Right. So the withholding estimated is only going to be, you can only use that if you have wages. The only other way that you could figure your estimated taxes, either it's going to be you have to pay, you can use as a starting point, you can use 100%, you can base it off of 100% of the total tax paid in the prior year. So if you, let's say you paid $10,000 in taxes in the prior year, your estimated tax payments, you can make 4 quarterly payments of $2,500, or it has to be at least 90% of the total anticipated taxes for the current year. And you can kind of estimate the total income you think you might receive for the current year, but you should use you can use the worksheets and the publication or the Form 1040 ES form. But using either one of those methods, you would avoid the estimated tax penalty.
So this was a follow-up, and I apologize, I can't remember if you ended up finishing the question or not, but yes, I'm talking about the QBI. So you don't need to include the QBI if you operate at a loss. That's what they're confirming.
I mean, well, the only way you would be able to take a QBI is if you have a net profit, because we base it off of that's how we base the calculation, off of your net profit. I'm assuming if you're using a tax software, it probably wouldn't even calculate the QBI.
Okay. Maybe we should just move on this one. Okay, so let's see what else we have here. Okay. If you haven't been making any money but investing your personal funds for startup business expenses, is there a requirement to still file taxes? If so, can you claim write-offs?
So you haven't started the business?
That's what it sounds like.
Okay, so you are only going to claim business startup costs once you start the business.
Right.
So you shouldn't just be writing off expenses year to year if you haven't actually engaged in starting the business, if you haven't started the business.
Okay. Are there real-world examples of small business tax returns in Schedule C that we can download to study and compare?
I don't think there are any real-world examples on the IRS website, not that I can really recall. what exactly are you trying to study or get a better understanding of? Because I can probably forward some references that you can review.
Okay, we'll see if they follow up.
Okay.
Is there a penalty if you do not pay your estimated tax quarterly?
So there's only a penalty if you did not pay at least 100% of the prior year's tax, or up to at least 90% of the current year's tax through estimated tax payments. So yes, in those situations, the penalty may apply.
Is it best to file our small business tax information with yearly personal? I filed jointly with my husband. Or is it best to keep at the IRS site and do all filing there?
I need some clarification on that
Okay.
one.
Yeah, I think they're trying to, if it's to be kept with their personal because they're filing jointly with a couple, with their husband, or is it best to keep with the IRS site and do all filing there? I'll see if there's a follow-up to that. We'll come back to that. So, if you are, let's see, if you're a home lifestyle blogger, are improvements to your home legitimate business expenses? If you're blogging about these improvements, what percentage of these improvements can be deducted?
That you would need to seek tax advice from a tax professional.
What about apps or software purchased from other sources of doing business? Guess they're wondering if they can write that off. I'm not sure.
As again, I'm just going to go back to IRS code section 162. If the expense is ordinary and necessary for business, and you incur the expense and it's paid, then the expense might be deductible. But again, you should consult with a tax professional if you're not sure.
So this person's wondering if they can write off time. I think I run a media company. I sometimes work with nonprofits, and wondered if when I create a video for them, my cost is time. Is that deductible?
I can't say for certain that you cannot take a deduction for the value of your time.
There was an earlier question when we were talking about the receipts, like an overall receipt and then receipts below. And this, they're clarifying, it was a missing receipt if you paid for something and you didn't get a physical receipt. I think that was asking if they could put it on a spreadsheet, and I think you covered that.
Mm-hmm.
Right. Let's see. So someone's asking, can we add gas purchases? I have a lawn care company, so my equipment requires gas in it. Can I add that? I mean, that would, I guess, again, it's an expense, right?
Yeah, I mean, you need the gas too. It's an ordinary expense for your business if a lot of your equipment is gas powered. So you just have to make sure you differentiate the gas that you're using for the equipment as opposed to the gas that you're putting in your vehicles. But yeah, it's a deductible expense.
Okay. Here's someone thanking you for your time. So I wanted to
Oh,
share.
you're welcome.
That was helpful. Let's see. Does paying with a check suffice as a record of payment? The company did not provide a receipt, so I was wondering if we need to pursue them giving us one.
It's always nice to have a receipt, but if you pay by check, then just make sure that you include in your record keeping system just a summary or an explanation of that particular purchase.
So earlier that there was a question about going from a home-based office to the leased space. They're elaborating. The leased space is a Regis co-work space. I primarily use lease space for meetings and a
Oh,
professional
okay.
office front. I never actually work in the lease space.
Okay. Okay. That's provides a bit more clarification. So it's like
Okay.
a leased workspace. So yeah, the expense that you pay to lease the space, that's deductible, of course, as a lease expense on your return. And then because of course, the lease space is a temporary work location, it's probably you're just going there to have meetings, then it would be the mileage would be deductible.
Let's see. Does the 1040 ES help us compute what should be included in the estimated tax liability, like SSI, Medicare, or Social Security, Medicare, state income, etc.?
Yeah, so the Form 1040 ES form, you want to include the income that you earn from self-employment as well as all other sources of income so that your estimated tax payments are as accurate as possible.
What
There's
is
a
the
work.
best? I'm sorry.
No, I was saying that there's actually a worksheet in the 1040 that comes with the 1040 ES. Yeah, it's a worksheet with the 1040
Okay.
ES. So you can include that income there.
Okay. What is the best way to record mileage for tax purposes?
I can't really recommend any methods for recording mileage. I mean, I know there's a lot of apps out there. I would say maybe review some of, check out some of those apps, read the reviews, test a few of them out to see how you like them. But we can't really recommend any method for recording mileage. We just have to tell you to record mileage, and that when you record your mileage, make sure that it includes the date that you traveled, the locations that you traveled to and from, and the number of miles, and then the purpose of that trip.
Okay. Is it true that meals must be purchased from a restaurant or similar and not from a grocery store?
I haven't really heard that anywhere. I don't. Are you talking about for entertaining clients?
I think so.
So like,
I'm
I'm
not
assuming
sure.
that you prepared a meal for clients. That's not anything. There's not anything in the tax law that says that you can't purchase groceries and cook for and prepare meals for potential clients or current clients.
If you provide a product and you are contracted as a vendor at an event, is the vending fee written off? If so, how should it be classified? Would it be a travel expense? Would there be travel expense to and from the event? Not to be at the event.
If you incur the expense for business, of course you can write it off. You should probably talk with your tax professional to see which category it best fits in, and then because wherever you're vending is a temporary work location, that mileage could be considered deductible.
Okay. Let's see. Okay, did I hear correctly that you must file self-employment tax if profit is greater than $0?
This should be 400.
Okay, I think
If you
that,
have
okay. So hopefully they heard that. If a CPA prepares your taxes and they make a mistake on your return, are they on the hook at all for penalties that the IRS charges?
well, I really can't say if they're on the hook or not. Ultimately, you are responsible as a taxpayer for the information that is included on your income tax return. So you are responsible for the tax liability. And if you're audited or receive some type of notice saying that you missed some certain income, ultimately you're going to be responsible for that. any additional taxes, penalty, and interest. If you feel like your preparer was negligent, there are ways to possibly report your preparer for negligence, and maybe he'll be penalized that way. But as far as the actual bill that results from any changes made by the IRS, you are going to be responsible for that.
All right, we are running out of time. We have a couple more questions. Yes, that she meant to say 400, so I think we're good there. When splitting the cost of a cell phone and internet home office 50% for business personal filing Schedule C as an LLC, can the business reimburse personal bank account if I've attached a bill for business purposes? Are you following?
I follow, but again, you should consult with a tax professional.
Okay. Okay. Let's see. Okay, I think you answered this. The startup expenses for a business, do they need to be claimed the same year you start a business? I think you answered that, right?
Right. So they have to be claimed in the year that you start the business, but the expenses don't necessarily have to be incurred in that year, if that makes sense. So let's say this is 2023. If I start a business next month in April, but I incurred expenses beginning last year to get ready to open this business, then even those expenses I incurred last year would be considered startup costs for 2023. And I would then take a deduction for that when I file my 2023 return.
This is an elaboration. The person was looking for real world examples, just said, this is all new to me. Seeing those examples of how the whole return works would make more sense to me.
Okay.
So I just want to see everything.
I can see what we might have available in maybe our video portal, or see if there are some previous webinars that might have been done that really go into a bit more detail about the Schedule C. And if I have that information, I'll share that with you.
Okay. If your business is on YouTube, would beauty or hair care be an expense since you are supposed to look a certain way?
Again, you should probably speak with a tax professional, but I'm just recalling back from my days of auditing, we did not allow a deduction for grooming. So
Okay.
yeah, just
I'm sorry.
in general, we didn't allow a deduction for grooming.
Trying to see if we can get through these quickly. It looks like estimated taxes are required if a tax owed will exceed $1,000. Is this quarterly or for the year? If quarterly taxes are owed, are you going to be less than 1,000? Do estimated taxes still need to be paid or filed quarterly?
If you expect to earn at least $1,000, this is not $1,000 per quarter, but if you expect to owe at least $1,000 in the tax year, then you should be making estimated tax payments.
Okay. Let's see. I started my business. I'm spending more personal funds on trainings and classes, traveling to learn and networking, but I haven't started making any money. Can I write off my expenses on my personal taxes without having made any money in my business, which is an LLC?
You should consult with your tax professional, because you're going to need to go into detail about what activities you're actually participating in. I really can't say just based off of that information.
Okay. Okay, for farms, is it better to take the fuel tax credit, Form 4136, and record gallons of fuel used rather than dollar amount of fuel purchased?
Again, I'll probably consult. Yeah, that's pretty specific. You should consult a tax professional.
Okay. Let's see. My husband and I are building a second home. One day we'd like to start an adult home, would we need to file that with our joint tax return, or is a separate business return? Can the monthly mortgage be used in the return as an expense?
The way you set up your business structure is really going to determine what type of return that you file. So again, you should consult with a tax professional. But if you're setting it up as a like a joint venture on a Schedule C, then your Schedule C is that income is reported on your personal your 1040 return. But again, it's really going to be based on the type of business structure that you set your business up on, which type of tax form you use. So consult with a professional to see what type of business structure is the best method to use for the type of business you're trying to build. And then they'll let you know the forms that are going to be required.
All right, I think we have time for one more because I think we're about out of time here. So I have an LLC and it is in the auto glass industry, started in November 2022. First job was actually in February of 2023. Does the IRS require most small companies to file their taxes quarterly or annually? What publication can I read to learn more about that?
Well, income tax returns are annual returns. You make quarterly payments on the income that you earn from that business. And the publications that I mentioned and in the workshop could be very beneficial. I would start with publication 334. That is publication 334 is Tax Guide for Small Businesses. And then publication 535 would definitely be another good resource because that goes over your business expenses. So those are probably really good places to start. And then the Small Business Self-Employed Tax Center also has a lot of great information. It's divided into sections. There's a section for starting a business. There's a section for operating a business. We even have a section for closing a business. So those are some really great starting points.
Great. All right, I think we do need to wrap up. I think we've got a little bit over our time here. So Anika, I want to thank you. This has been so informative, as always.
Well, thank you for having me, and sorry about the few technical difficulties that we had, but I think overall, hopefully everyone benefited from today's presentation.
Right, and with the slides and the recording that'll go out, hopefully it'll all mesh together.
Okay.
So yeah, I want to thank everyone for attending today. Again, you will receive an email with the link to the recording and the slides, and all those fabulous links that Anika talked about. If you'd like to sign up for upcoming webinars or access recorded webinars, please visit virginiasbdc.org/training. These resources are designed to be used in collaboration with your local SBDC advisors. You can sign up for a free and confidential session by emailing help@virginiasbdc.org or via our website. We hope to see you at our next session. Take care, everyone.
Take care.